is going to join us. We're going to do a little trading here, Alan, in the healthcare space. The Chief Market Strategist at Agora Financial. All right, so Merck, let's talk about this because the company got dragged down with this whole healthcare route a couple months back. Does it deserve to be down there?
Opportunity.
All right.
Nothing's changed in the big picture. We're still just a couple weeks off those all-time forever highs, and the bounce back that we saw last week in the S&P has been a predictor of new all-time highs if we have a full V recovery, because we got up to the halfway point of the sell-off. The VIX is 25% off its highs. Gold was down $10 last week, so everything still remains very bullish and very positive. Let's get to Merck. Merck is only up 3% in 2019 compared to the Dow itself, which is up double digits, but the Dow is still lagging. The Dow never made new swing highs, never took out its October highs on this last rally that we saw in the S&P and in tech. So I think there's opportunity for a snapback attack, not only in the Dow, but Merck as well, because it's one of the laggards in the blue chip index.
This makes a lot of sense to me, Alan, because I look at the chart for Merck, and I know you're a technical guy, but we can pair it together here a little bit, all right? This is the beauty of, having an open mind and thinking on both sides of the aisle. From the fundamental side, this company, as we were talking stock dispersion within some sectors, healthcare has also been one of them, right? Where, you look at Merck versus BMY, it's just crushing its peers. The Keytruda drug has taken off, and they're showing major growth in a time where, pipeline and exclusivity has become paramount to being a successful big drug company. Then all of a sudden, Merck goes completely red throughout the month of April with no news behind it. So there's the fundamental side to me that doesn't really match up. And then the technicals compared to itself, compared to its sector and the rest of the market, to your point, also don't really line up.
Well, I try and make it very simple when it comes to the fundamentals that you're talking about here. Look at how many lines they have that bring in more than $1 billion in revenue. I think it's double digits. So, this is a big money maker. Now, to get back to my side of the trade, very simply, this stock has been stuck between 70 and 80 for now 8 months. So that predicts a breakout move up to the 90 level, which is about 15% above where we are right now. So I'm looking at the $75 call using a stock substitution strategy again, very straightforward. So the midpoint of this action is 75. So I'm looking to be long the 75 call for July. July option has 60 days. Now the June option, even though I'm looking for a more accelerated move, the June option is only $25 cheaper. So with volatility coming back down, it's better to buy an extra month of time for an extra $25. It's mathematically, it would be malfeasance not to. So the July option, 60 days in the money, and we're looking for this to have a bit of a pop. Now, if the stock does pop to 90, this option gains 300%. So that's the idea here, is you're putting down a limited amount. This option is going to cost about $475, and it's $350 in the money, 2 months of time, and let's see if this insiders, which my indicators are saying, are loading up on the stock, that they see something and look for this market to break out.
All right, there we go. Alan Uckman.